This is Jeffrey Tucker, Brownstone Institute. We were founded mostly to address the COVID crisis in 2021 and the lessons it teaches us. The events of the last week or two have given me a profound sense of deja vu of March 2020. If you recall, the COVID crisis began with Trump under the Trump administration. He had, for a couple of months prior to March, I'm going to say 16th, 2020, or really March 12th, said this flu will pass. It's seasonal. We'll get through it just fine. Our doctors know what they're doing. Something happened on March 9th and 10th that changed his mind. He realized he could use all of his power to take on the virus and be better at it than Xi Jinping, who the World Health Organization had reported had crushed the virus through raw uses of force and thereby completely eradicated COVID from the mainland of China, which we know was just a complete bunch of baloney. But the World Health Organization codified that, said that was true, apparently went to Trump and said, you too can be great. I don't have documentary evidence that this is what happened, but something happened that caused him to change between the 9th and 10th of March from a very reasonable position to an eradicationist position to use all powers of the federal government to get rid of COVID, as he said in a tweet of March 10th, 2020. So why do these times with this Iran war remind me of that? It seems like, well, for one thing, he's destroying all of his economic achievements. And oil has now hit $103. Gasoline's up to $3.70 on average throughout the nation, higher where you are, or maybe a little lower where you are. But it's, in any case, it's up a full dollar over what it was 18 months ago. And it's certainly a lot higher than when Trump took office, thereby taking away from him one of his great campaign promises. So, namely, to be a champion of economic growth and affordability for the American people. That's exactly what happened in March 2020. He seems to have gained some confidence that he could prosecute this war in a short period of time by taking out the Ayatollah, who's the leader of the nation, confidence that he gained from his experience in Venezuela, where they went after and arrested Maduro and immediately was able to gain control of that government and its oil supplies. And perhaps he believed the same thing would happen in Iran. So he's definitely misdirected there. And also the demand that we trust the plan. Just trust the plan and everything's going to be okay. Oil prices are going to come crashing down, as somebody, as I think he said just yesterday. Don't worry about it. The stock market's going to come roaring back and everything's going to be wonderful and oil prices are going to crash to the ground and we'll get rid of this horrible regime and then everything is going to be fine. Very much reminded me of what he said March 2020. The virus will be eradicated. They're doing a great job. Just wait 2 weeks. We heard this and heard this and heard this. And then, of course, he was driven out of office. The betting odds on the midterms are looking absolutely terrible and worsening for Trump. We're looking at full sweep by the Democrats and the SAVE Act, which is the last sort of great hope for the Republicans in the midterms, looks like it's in trouble for whatever reason. So we're looking at a parallel situation, and one wonders who convinced Trump that he could just do this, just march in with all force and make the regime comply just because we have superior arms and so on. And of course, it seems like every day he declares that we've won, except that we haven't won. And now he's asking for allies to join in keeping the Strait of Hormuz open for American allied oil, but other countries are not joining. And the funny thing about the plea for other countries to join is that it contradicts his own anti-globalist outlook. You remember, American was going to be a lone actor, reasserting its political independence against globalism. Now suddenly, that's changed too, and we're pleading for globalism to save this war effort. At least that's my read on it. I could be wrong on every single bit of this, but there's just been, I think I learned during COVID to not trust the plan and to see the possibility of profound error as a ubiquitous failing of all political systems. And I think we might be seeing that right now. But to give a check on where we are and how this is affecting the financial markets, which are being profoundly affected by this crisis, more so than in the COVID crisis. I think we're seeing some real disruption here, and nobody knows what the effects of the change in the dramatic increase in the oil price is going to be on world markets. I brought in Ed Dowd, who's just a great friend of Brownstone and an excellent economic commentator, analyst, financial expert. Very pleased to have you here, Ed. Thank you for joining me.
Jeffrey, great to be here. Thanks for having me on today.
Well, to start off, what was your read on my little opening short monologue? Superficial.
No, you're spot on. You're like me. You're watching what's going on, and we're analysts. And to say that the messaging is mixed from the Trump administration would be an understatement, I think. I've taken the personal choice of not calling the war, and there's just not enough information. So I'm focused on the price of oil, and even that's become a problem because there's great speculation that the Treasury has interfered in the futures market in the suppressing oil prices, and at least in the futures market. Spot oil in Asia is at $140 a barrel, and it's around 100 in the futures. So people are pointing to the physical asset being 140 as the real price versus the paper price of 100. So there's a lot of problems going on in the markets, and the truth is hard to figure out, but I'm going to go with oil is really trading at 140. And until oil comes down, that will tell you what is going on in the war, whether it's escalating or de-escalating. So I'm tuning out all the noise, all the comments from Trump and his administration, and I'm just focused on the price of oil. And right now, it's not coming down. So this is going to be longer, I think, than they thought. This is a very complicated situation, and it's not going to end anytime soon, in my estimation. And we were already economically rolling over. The GDP number came in, it was 1.4% for Q4. It was revised down this week to 0.7. So it was 50% haircut to the GDP initial estimate. If you back out the data center AI GDP number of about 1.5%, which doesn't really add to the labor force. We were negative GDP, and I contend that AI CapEx is going to be rolling over very soon. It's already starting to show signs of cracking because the debt markets are questioning the ROI on the whole complex. There's not enough revenues to support the CapEx spend. There's a realization that AI is becoming a commodity. There's 5 different AI engines, and it's a commodity at this point. It's hard to. People won't believe that, but it looks like it's a commodity. And so, with all this CapEx spending, there's going to be a pause. The other constraint on CapEx is power now. It used to be NVIDIA chips. So the gating factor is power, and we just made the power complex that much more expensive. So we don't have enough electricity and water to fund all this CapEx. So the CapEx has been driving a lot of the GDP, especially NVIDIA, which is one of the largest market cap companies in the world. And we have an AI bubble, a stock market bubble. It's a .com valuation. So The economy was already rolling over. We have now private credit, which before the war was declared was starting to blow up. Private credit is a opaque form of financing that really took off the last 2 years. It's grown conservatively 50% from 2022, and it's very opaque. It's done behind the scenes. And then the brilliant people on Wall Street decided to open this up to retail. And retail is not as sophisticated as institutional investors. So now we're seeing retail head for the exits, and we're seeing private credit gate their withdrawals because these assets are illiquid. And then this week, one of the biggest things that I think happened was J.P. Morgan, Jamie Dimon, started marking down values on their loan books for these private credit instruments, and they also are cutting credit to the private credit funds. So that's when J.P. Morgan does this, other banks will follow. So the engine of money creation is now going the wrong way. And you throw in the Iran war, an oil price shock. People are claiming that the Fed has to raise interest rates, inflation's coming back, but this kind of oil shock is very deflationary. It's demand destruction. We do not have the same demographics that we had in the 1970s. We had baby boomers demographically entering the workforce with wages growing. Wages are not growing, so this is going to be demand destruction, and it's not good. I think we're setting up for a very bad economy into the midterms, globally as well. We put out a report at the beginning of this year talking about China. China's entering the acute phase of its economic crisis, which no one really understands, and the China numbers are just bad, and that's why they're ramping up their exports. They need to export their way out of this. Their net private investment is now below zero year-over-year growth for the first time ever. If you take out the COVID blip, that's in their 30, 40 years of their industrialization, it's never dipped a year-over-year growth below zero. Electricity consumption is heading towards zero year-over-year growth. So we have all sorts of forces bearing down that no one. Not to mention a housing problem, which started rolling over last year, and housing is 20% of the economy. So there's all these forces that are endogenous to the economic cycle. It's the cycle. No one can really stop it coming. The oil shock is exogenous. So Trump has some measure of control, but not as much as you would think. This isn't like the tariffs where you would place tariffs and then take them away. So this is an extremely difficult situation to assess. But what I can say is the economy is going lower globally and in the U.S.
You just connected two huge topics that had never even occurred to me that they were related, namely the oil crisis with the AI bubble, which reminds me of the dot-com thing. And then you mentioned a bunch of other things in there too. Somewhere in there, I'm not sure exactly what we should take on first here, but I mean, that was an unbelievable insight. It never even occurred to me that of course the AI bubble, its sustenance depends on cheap energy. That had blown right past me. Wow, what a brilliant connection. But let me just there's so much to talk about. Let's go back to the GDP numbers. I'm not sure what to make about GDP numbers in general anymore. When I saw that 1.5 figure, or I think it was 1.4, I looked at the sources of growth, and if memory serves, it was consumption of healthcare services and other things that, and also the balance of imports and exports seemed to give it a jolt. So that already raised alarm bells to me. But to see it cut by half, it really makes you wonder about the credibility of these initial prints at all. Like, why do we even pay attention to them? Actually, I'm not even sure why we pay attention to these numbers. But the thing that really rattled me, and I wonder if this is true for you too, was the Friday jobs report. That's the one, right? I pulled it up and I thought, okay, which sector is losing? And it was like 92,000, right? It was a big drop in employment. And which sector is losing? Well, it wasn't just which sector; it was every sector. It's retail and hospitality. It's just like across the board, everything. They're shedding employees all over the place, and then when you look at the revisions over the last 13 to 18 months of the labor numbers themselves, I saw one figure that calculated a total of 720,000 sort of ghost jobs in aggregate that have been reported but didn't actually exist over the last year and a half.
Yeah, so let's talk about the jobs numbers. We've been tracking a problem in the non-farm payroll number for about 2 years. There was, during the Biden administration, it was noticed there was a pattern of a good jobs report then revised quietly and secretly, in subsequent months. And then we did, that's when I discovered there was, in my whole career in the capital markets, we focused on the non-farm payroll number. Most of us didn't even know there was an actual reality book reporting called the Quarterly Census of Earnings and Wages, which came out from the same people that developed the non-farm payroll, which is the actual number. When the 16 million employers report actual wages earned and the people employed, the monthly non-farm payroll estimate is just that. It's an estimate, and it usually tracked reality, with a small error rate. It was never perfect, but it was always in the ballpark. Then I discovered, years after, 30 years in the business, what a quarterly census earnings and wages report is, because it started to dawn on us that reality and non-farm payroll were way off. And just to give you an idea how far off they were, in 2024, it was non-farm payroll was off 4 standard deviations to the upside versus reality. And in 2025, it got worse, 8 standard deviations. And that's why we're seeing these massive revisions downward, that they came to light in the last couple months. Now, the minus 92,000 is even more alarming, because obviously with all this chicanery going on and misestimation, they couldn't even hide that. So I suspect that minus 92 will get revised even lower. It'll be even worse. So the question is, what is going on with the non-farm payroll estimate? Is it, I talked to many economists, and there's whispers. Some will say it's bureaucratic incompetence. Others will say it's fraud. Others will say it's a combination of both. And then I started thinking,
these are just to be clear, these were. So there's 2 ways to understand the jobs numbers. One is what businesses report, and the other is what households report, right? So which is the 92,000 figure come from?
That's the establishment survey. The household survey is different, and there's been a disconnect between the household survey and the non-farm payroll number for a while. But everyone focuses on the non-farm payroll number. That's what capital markets trade off of. That's obviously going to start changing as we roll through time, if this number continues to be as off as it is. So is it fraud? Is it bureaucratic incompetence, combination of both? Or, I floated another idea in a tweet a couple of weeks ago. I said, maybe it's national security at this point. I don't know. In the bowels of the deep state, is it been determined by the National Security Department of Defense that we need to keep the engine of money creation going, so we're going to lie as a matter of policy? I don't know. That's just speculation on my part. So those are the 4 options: bureaucratic incompetence, fraud, combo of the 2. Number 3 and number 4 is national security issues.
But another possible one, after COVID, the compliance with the requests that institutions report, how many employees how many jobs they've fulfilled over the last month. Even the reporting has gone dramatically down. I can't remember the exact numbers, but there's far less like participation in the Department of Labor's requests, right?
I'm not sure about that. The survey, the non-farm payroll survey, is 600,000 employers, and then the quarterly census earnings and wages is the 16 million. That's That's the book report after the estimate. But the fact that the estimate's that far off, it just suggests, the four scenarios. And, I've talked to a couple economists, and they're being generous when they say it's bureaucratic incompetence. Some whisper it's fraud, but they say, I can't say that publicly. Well, I can. I say what I think. I don't know the answer, but I do know the number is so far off, it's making the non-farm payroll report almost, useless at this point.
Yeah, so we've got this major labor problem, and by the way, there are two ways to measure the extent to which the population is even involved participating in the workforce. One is the employment population ratio. The other is labor force participation rate. Both seem to be declining, and neither have recovered from 2020.
Yeah, that's correct. And I'm reading. I haven't verified this, but I'm seeing posted on X by Zero Hedge and others that there's 100 million Americans are currently not working that should be working. That's an alarming number if that's true.
Yeah. So we've got major stickage in the labor markets. You have, I don't know if we want to divert over to this, just parenthetically, the problem of disability, which has, well, maybe just map out what happened to the number of people that are reporting being disabled. And these are disabled workers and non-workers.
Yeah, correct. So the BLS, the Bureau of Labor and Statistics, has a series called Disability, and they've been tracking it for a while now. And prior to COVID, so let me explain. It's a survey, much like the non-farm payroll. It's done monthly. It's statistically imputed from a phone survey. If you answer yes to one of 6 questions, they label you as disabled, and it's not tied to a disability payment. You're not going to get dinged if you say no to it. It's just a matter. I've experienced these questions. I was a participant during COVID for a couple months, and I answered the questions honestly, and I didn't even understand why they were asking me some of these questions. But then I figured out later, some of these questions are not necessarily related to employment, but in disability. And the number was running around 29 to 30 million prior to COVID. And then in February of 2021, and we started tracking this early days, it had a 3 standard deviation. It began a 3 to 4 standard deviation inflection upwards. And by September of 2022, we had added 3 million disabled Americans, half of which were employed at the time, which is very interesting. Employed people tend to be healthier than unemployed people. So that was a tell for us something was going on. Obviously, I'm on record claiming that the COVID vaccine has a lot to do with this. But that number continued to tick up. And, fast forward from 22 to 26, we added another 3 million. So we have 6 million disabled Americans, many of which are employed. So that's an alarming number. And, whether you believe me or not that it's the COVID vaccine, at the very least, it needs to be investigated. And a lot of people say it's fraud, but I contend it's not fraud and it's not demographics. I looked at the aging of the population. That could only account for maybe 10 to 15% of the rise in the number, but not what we saw. And, look, when you look at the chart, it's flatlined and then it inflects up like a growth stock. It's like, I look at it like I'm a finance guy. So it was basing for years, then inflected up at a 45-degree angle. So our demographics are part of it, sure. Is there fraud? No, because it's a survey. Something else is going on in the health of the country. And, it's still, this is not widely reported. It's ignored. And I'm just baffled as to why we don't talk about this more.
Yeah, isn't it just so remarkable? And to be clear, there's no real financial incentive for anybody to report themselves to be disabled in these surveys. So,
No, but it's
uh,
not tied to it's
so
not tied to
yeah,
a disability claim.
yeah, yeah, and the data is very real. So, so that impacts also the labor markets. So we've got sort of bad signs all around. Very low labor participation, high disability rates, job losses in every sector, over-reporting that is shaved off later in both jobs numbers and in GDP. Um, uh, uh, let's just touch briefly. I know you think that there's deflationary pushes here, but the CPI numbers are not looking good. They came in at 2.4, which is still running hot by any standard over the last several decades. Um, and isn't there a sense in which these oil prices are going to bleed into other forms of price increases, potentially kicking, bolstering this inflationary sort of trends? At least that's how I read them. In a world in which most people are longing for 2019 prices.
Well, 2019 prices aren't coming back. We had this massive run up in inflation, and the inflation number is, the rate of change. So yes, inflation is trending lower, but the halcyon days of 2019 are never coming back. And the problem is we have, and this cost push inflation is going to feed, like you said, it's going to feed into all sorts of things: food prices, gasoline prices, electricity bills. That's going to cause demand destruction and other things. And what that's going, so we got inflation in things that you need, and we're going to have deflation in things that you don't need, like expensive homes, stock prices. So the asset markets are going to eventually expand because the credit cycle's rolling over, and the consumer is going to start. Has high delinquency rates on credit cards and auto loans. It's going to soon hit more. It's already hitting mortgages. So we're going to have a deflationary impulse once these cost push prices go through. So it's going to be demand destruction on the other side. So you're going to see, the knee-jerk reaction from economists and the Fed will be, I suspect the Fed will do nothing at their next FOMC meeting. They'll pause, citing inflationary pressures. That'll make credit even more tight. And eventually this turns into a full-blown recession and a short, brief economic crisis, because we all know the Fed's going to do what they're going to do. The fiscal response will be there, and then we'll try to reinflate this again. But there'll be a definite deflation in assets, but not deflation in what you need, unfortunately. So people are just going to cut back.
I see. You just reminded me of another trend that I wanted to mention. I saw that 30-year mortgage rates have ticked up from 6.0 to 6.3, something like that. Does that suggest a general sort of steepening of the yield curve, or are we looking at just increased rates across the board?
Yeah. So there's a lot going on in the financial markets. So the swap spreads are indicating 5-year inflation spreads are indicating that inflation's coming down. Believe it or not, because they're looking 5 years out. Pricing is saying this eventually is going to be deflationary. But near term rates are going higher. The mortgage rates were ticking lower, but that wasn't stimulating any demand. Pending home sales were at the lowest ever, I think, last month. The real estate market is effectively frozen. We have this historical, never seen before gap between homes for sale versus homes sold. It's a time series that you can track. And generally speaking, they match over time. But since 2022, we have this alligator jaw situation. Homes for sold are here. Homes for sale are up, are the upper finger. My thumb is homes sold, and it's about 600,000 gap. So that means there's a buyer's strike because affordability. We've done the math. We think home prices are 30% too high. So there, one of two things needs to happen. Wages need to grow, employment needs to grow, or home prices need to come down. And given what we're seeing in wages and employment, home prices need to come down. And there's just a frozen real estate market. I was talking to some other people. And a lot of the people that are selling the homes are older people, boomers for the most part, comprise most of the sellers. The buyers are the younger folks, and there's this mismatch between the two. What will get the pricing to really come down would be a stock market bubble bursting, because that would start to maybe upset boomers who then feel less wealthy and then will lower prices on their homes. So we think they're both related. Once one starts to go, the other one will go. And we're just waiting for this détente to happen. And we're already seeing home price problems in the southeast near the border, the southern part of the southern red states. The blue cities still have high prices, but we suspect, we get white collar layoffs, which are occurring right now. Meta just announced a big layoff. We're going to see prices in blue cities come down. So it's all points to a softening economy. The risks, we identified 3 risks: the housing problem, the AI bubble, and China, which is going to affect their regional partners, which will have global impacts back home here.
What is your read on the trade situation? Obviously, we've gone from a world just 10 years ago of aspirations for universally low tariffs, everybody trading with everybody else, to a kind of a panicked policy of like, we're going to rebuild our industrial base through tariffs, which has diverted trade in different directions all over the world and created these various trade blocks. At the same time, we're seeing a loss of manufacturing jobs in the U.S., which is not what was predicted. And I'm not sure about the latest print, but we've not really seen an improvement in the trade deficit. So those two are supposed to be the very thing that the new trading order was supposed to fix, but they don't seem to be being fixed.
Yeah, the problem with what's going on is it takes time. So the idea at the beginning of the administration was, we're going to do tariffs, and then we're going to incentivize people to invest in the U.S. The problem is it takes time for these trade deals to get ratified. I don't think people really understand. Before the courts did what they did, and now there's a new tariff regime. Before the courts did what they did, the EU and Japan had agreed on paper to some sort of deal, but their respective parliaments hadn't passed it yet. So there's a gap between deals and then investment in the U.S. and breaking ground and building plants. Unfortunately, Trump's messaging was that he brought $21 trillion into the U.S. in the fourth quarter. Obviously, that was in announced deals. It was not actually money being put to work. So that was the idea. And when we did our investigation into China, it makes sense that something needs to be done. Whether you can argue about how it gets done, but the problem with China, and this is all driven by demographics, is they plateaued demographically in 2015, and they really started a demographic decline in 2020. And that's when their real estate crisis began, and their internal consumption started to plummet. So to make up for that, they started exporting even more and started dumping. China is in a deflationary death spiral because of demographics. So they are risking the global economy by dumping their cheap goods all over the world, which would wreck a lot of economies. So Trump, in theory, is doing the right thing. Whether you're executing on it well is another thing. But this is a global problem. China, people may not know this, but China has 47% of the world's money supply. 47%. So that's a national security risk. It's trapped in corporations and whatnot, but they can buy all sorts of assets, which is soft power. So by outsourcing our industrial base over the last 30 years to China, they've accumulated 47% of the money supply. That's the fact. And I don't think people understand that.
Yeah, in dollars and in
in
euros
dollars.
and in their own currency.
Yeah.
Yeah. So, and
Now, the only reason
everything, which is a major.
The one thing people need to understand,
Right.
even though they have 47% of the world's money supply, their velocity of money is way lower than Europe's and ours. So that's why their money's trapped and is looking for places to go, and that's why they're having a deflationary problem, because one of the things that could help fix the world is if China decided to become a more consumer-facing economy. But that necessarily means they have to give up power. So that giving up power is not easy to do, but they could do it. But that's one of the biggest problems is China is not, their cheap labor and their slave labor is not participating in what's going on in China for the most part.
Is that this low velocity? Is that just due to very high savings rates? Like it's a cultural thing in China. Everybody just likes to sock away their money.
Yes, because they don't have a social safety net like we do. They just don't. So everybody socks away money. One of the things they could do is create a social safety net, invest in consumer-facing businesses. Their whole economy is geared towards internal real estate, which is now on a decline, and exporting to the world. So, homes for the workers, but no social safety net, not a lot of consumer-facing businesses growing in China.
What do you make, back to the Strait of Hormuz? So I think a lot of the reason the world's on edge right now is because the oil is not getting through. But I just read a report that Iran, which apparently controls the strait right now, which is not, I think, what was supposed to happen, is willing to let ships pass, provided they were dealing in Chinese currency. And if that's true, it would seem to reinforce the long-term ambition to displace the dollar as a world reserve currency.
Yeah, look, I'm not in the camp that the dollar's doomed and that the BRICS are going to be successful. I'm a believer that the dollar is a reserve currency, and reserve currencies die slowly. It may be in the process of dying, but it's not going to happen overnight. And I don't know if anybody's watching what the dollar is doing. It's having a fabulous rally since this war started. It's over 100 on the DXY. I follow cycles. These large asset classes like bonds, equities, and the dollar have cycles. And we were expecting a 4-year cycle low last year. We got one. Then we got an undertaking of that low recently in the beginning of the year. So we had what's called an extended 4-year cycle low. So cyclically, the dollar is going to go up, and it makes sense. In a credit contraction, there's a need for, when you reduce, all our debt is dollar based. So when you have a credit contraction, which we're expecting, the dollar actually goes up because there's fewer dollars as debt creation slows and or defaults. And now with the price of oil doing what it's doing, and also tariffs were deflationary and also ultimately deflationary and increasing the demand for dollars. So we're going to see the dollar have a huge rally over the next 6 to 12 months as we go into this economic problem. So the death of the dollar is not here yet, and people need to understand that weak dollar policy is the way it's been since the creation of the dollar. When you see a boom in the economy, the dollar usually weakens because we're creating credit and dollars. In recessions, the dollar tends to strengthen, and we're going to see the dollar strengthen, in my humble opinion. And that's not going to be good for risk assets.
and it's not going to be good for the trade deficit or for American manufacturing either, right? The stronger the dollar is, the more.
Yeah.
Yeah.
It's a conundrum.
It's
It's a conundrum because of the dollar system is a debt-based fiat system. So the more credit, the weaker, the dollar goes lower, the more credit creation in dollars, that is.
Yeah. Okay. Well, thank you, Edward, so much for your outlook on this. Is there anything else you want to add about the current trends and its dangers? One of the things that strikes me is that during the COVID period, we actually avoided a financial crisis, which is glorious. But one wonders if the nature of this current crisis is such that it will impact financial markets a little bit more than the last time.
Well, going into the COVID crisis in 2019, we were having a global economic growth slowdown, and we were having lots of problems with the plumbing of the financial system. COVID was a war, and it was war-like spending. We'd never seen that kind of spending and increase in the monetary supply, and that unleashed inflation. And here we are a mere 6 years later, and we're having problems again in the plumbing starting to show up. And so the question is, can they save it this time? And what's the excuse going to be? They need the nature of the system. It needs ever increasing amounts of credit at accelerating rates. So the next stick save is going to have to be huge. They're going to need a justification for it. I've always been on record saying it's either going to be a war or, I know I'd say this tongue in cheek, but aliens coming so that we have to spend for global safety measures that could justify the kind of spend. But they're good to save it this time. They're going to need to print tremendous amounts of dollars and have an excuse for it. And COVID for a time saved the system, but the system needs another sugar high. And unless the Fed and the government get together, we're going to see it, an implosion in asset prices first, then a stick save attempt. And however that manifests, I don't know. We don't know, but it won't be good. Whatever it is they use to print trillions of dollars.
Ed Dowd, thank you so much for your brilliant commentary. I appreciate the time you spent with me today. Thank you. All the best.
Thank you, Jeffrey. Great to be here.